Ever feel like you've got this giant pile of bananas, but you have absolutely no idea what to do with them? You hear all the other monkeys chattering about index funds and mutual funds and ETFs, and it all just sounds, well, really complicated? Well, guess what? It doesn't have to be.
In this explainer, we're going to break down all those big, scary financial words and make them so simple anyone can get it. Our goal is to figure out the smartest way for you to grow your banana pile for the future without getting totally lost in the jungle of financial jargon.
All right, here's our game plan. This is our map through the whole financial jungle. We're going to start with the absolute basics, like what even is a fund? Then we'll meet 4 very different monkeys, each with their own investment style. And by the time we're done, you'll have a super clear idea of which path is right for you and your bananas.
So, first things first. What in the world is a fund? Well, imagine you and all your monkey friends decide you want to throw the biggest, most amazing banana party this jungle has ever seen.
See, instead of one monkey trying to buy all the party favors and another buying all the music, you just decide to throw all your bananas into one giant pile. And with that huge pile, you can afford the whole shebang. And that, right there, is a fund. It's just a bunch of investors pulling their money together to buy a whole portfolio of different things, like stocks or bonds all at once.
Okay, now it's time to meet our first investor. This is Indy. Now, Indy is a really smart monkey, but he's also, let's just say he's incredibly lazy. He's our stand-in for the index fund. Indy the index monkey doesn't waste a single ounce of energy trying to find the best banana tree in the entire jungle. Nope, that sounds like way too much work. Instead, he just gets a list of the 500 biggest and strongest trees, we'll call it the Strongest Primates 500, and he puts a tiny bit of his banana pile into every single one. That's it. He just copies the list. This whole strategy is called passive investing.
And you want to know the absolute best part about being this lazy? It is so cheap. Because there's no genius monkey manager making a bunch of complicated decisions, the fees are just incredibly low. We're talking, for every 1,000 bananas you put in, you might only pay a tiny speck of a banana each year. It's almost nothing.
So yeah, Indy is one cool customer. He's super chill because his bananas are spread all over the place. If one tree gets a little sick and falls over, no big deal. He's still got 499 others doing just fine. That's diversification, and it's what keeps his risks so low. The only other thing to know is you can only buy or sell his fund once a day, after the jungle market closes for its afternoon nap. It's simple and it's steady.
Now let's swing over to a completely different part of the jungle and meet Monty the mutual fund monkey. Monty is the total opposite of lazy. You know the type. Wears a tiny suit, carries a briefcase, and he won't stop telling everybody he's a genius who can find the absolute best banana trees.
Monty here is what we call an active manager. He's working all day long, swinging from tree to tree, analyzing the soil, even tasting the bananas, because he's convinced he can pick the winners that are going to grow way faster than the average trees that Indy just copies. He's trying to beat the market. But, and this is a really big but, having a genius monkey work for you is not cheap. All that expertise costs a lot more. So instead of that tiny speck of a banana that Indy charges, Monty takes a whole bite out of your banana pile every single year. That means he has to be really, really good just to make up for that bigger fee he's taking. And here it is, the jungle's biggest secret. Get this, even with all his hard work and those super high fees, study after study shows that most expert monkeys like Monty actually fail to do better than the lazy copycat monkey over the long run. Ouch. Turns out it's almost impossible to consistently outsmart the entire jungle, especially after you subtract those big fees.
All right, everybody, quiet down. We're about to enter the exclusive velvet rope VIP section of the jungle now. This is where Hudson, the hedge fund monkey, hangs out in his fancy treehouse.
Yeah, you can't just waltz in and give your bananas to Hudson. His club is private, for accredited monkeys only. And what that means is you have to already have a massive pile of bananas just to get in the door, because the games he plays are super risky and way more complex. And his fees? Oh, they're on another level entirely. They're kind of infamous, actually. Hudson uses what's called the 2 and 20 model. So first, he takes 2% of your entire pile every single year, just for managing it. And then, if you make any profits, he takes another 20% of those. It is wildly, wildly expensive. So why on earth would any monkey pay that?
Well, it's because Hudson isn't just buying banana trees. He's using these super risky, aggressive strategies, like borrowing more bananas to invest even more money, all in the hopes of hitting a massive jackpot. This chart really shows you what's at stake. Yeah, the potential for giant profits is there, but so is the risk of giant, absolutely catastrophic losses.
All right, finally, let's meet our last monkey, Eva the ETF. Now, she's interesting. She's kind of like a hybrid, taking some of the best traits from her cousins we've already met.
The easiest way to think about Eva is like she's Indy the index monkey's super fast cousin. Just like Indy, she holds a big, diversified basket of all 500 trees. But, and here's the game changer, you can buy and sell shares of her banana pile all day long, just like you were trading a single banana from a single tree.
And this right here is the key difference. Remember how Indy's index fund only gets a price once a day, after nap time? Well, Eva's ETF trades constantly. The price is going up and down all day long, which gives investors way more flexibility and freedom.
Okay, wow. We've met the lazy monkey, the expert monkey, the rich monkey, and the fast monkey. So, when you're standing there with your precious pile of bananas, what's the smart choice for you?
This little cheat sheet just about sums it all up, right? You've got the index fund, our lazy monkey, lowest fees, perfect for someone who wants to invest for the long term and not think about it. The mutual fund is for people who really believe an expert is worth those high fees. Hedge funds, that's a high-risk game for the very wealthy. And the ETF is for investors who want those low costs, but also want the flexibility to trade.
So what's the bottom line here? Well, for most of us everyday monkeys out there who just want to grow our banana piles safely for the future, the choice almost always comes down to the two cheapest, simplest, and most effective options, index funds and ETFs.
So let's wrap this all up. If you remember anything from our trip through the jungle, make it these 4 things. 1. Start simple with low-cost funds like index funds or ETFs. 2. Spreading your bananas around. Diversification is your best friend. 3. Watch out for high fees. They are like termites for your banana pile. They will eat away at it over time. And 4. Always understand what you're getting into before you invest. You know, the jungle of investing can seem really intimidating, but it doesn't have to be. Just by understanding these core ideas, you've already taken the biggest and most important step. So now the only question left is, which monkey strategy are you going to follow to grow your future?